In 2016, GenesisCare, Australia's largest provider of cancer and cardiac care, was acquired by a consortium of investors led by China Resources Group and Macquarie Capital. The deal valued the company at $1.7 billion and gave the consortium a majority stake of between 50% and 74% in the business. KKR, the previous owner of a 45% stake in GenesisCare, exited the company as part of the transaction. The acquisition was motivated by the strategic vision of expanding GenesisCare's operations in the US and Europe, as well as tapping into the huge potential of the Chinese healthcare market. China Resources Group, a state-owned conglomerate with interests in various sectors, including healthcare, saw GenesisCare as a platform to deliver high-quality cancer and cardiac services to Chinese patients. Macquarie Capital, a global investment bank and financial services provider, saw GenesisCare as an attractive investment opportunity with strong growth prospects and a proven track record. The consortium also committed to invest an additional $300 million over 3 years to support GenesisCare's expansion plans. The company already had a presence in the UK and Spain, where it operated 22 cancer centers and 5 more under development. The consortium aimed to increase GenesisCare's market share in these regions, as well as enter new markets such as Germany and France. One of the most ambitious moves by the consortium was the acquisition of 21st Century Oncology, a major U.S. integrated cancer care provider. In May, the deal was worth $1.1 billion and added 143 treatment centers across 17 states to GenesisCare's portfolio. The acquisition was seen as a game-changer for GenesisCare, as it gave the company access to the largest oncology market in the world and a platform to introduce its innovative models of care to U.S. patients. However, the expansion strategy also came with significant challenges and risks. GenesisCare had to deal with a heavy debt load of $2.3 billion, which increased its leverage and interest costs. The company also faced operational difficulties in integrating its acquisitions, especially in the U.S., where it struggled with billing issues and recovering funds from insurers. Moreover, the COVID-19 pandemic had a negative impact on GenesisCare's performance, as treatment volumes declined due to lockdowns and social distancing measures. As a result of these factors, GenesisCare's earnings deteriorated and its losses widened in the past 2 years. The company reported a $147 million loss at the EBIT level and a $310 million statutory loss for the year ended June 30th. The company's net leverage ratio reached an alarming level of nearly 20 times earnings by June 2021, raising concerns among its lenders about its ability to repay its debts. To address these concerns, KKR and China Resources agreed to inject an extra $160 million into GenesisCare in June 2021, in a bid to shore up its balance sheet and buy time for its recovery. The company also decided to sell its Australian cardiology business, dubbed Cardiology Co., to domestic private equity firm Adamantum Capital for about $300 million. The sale would allow GenesisCare to focus on its core oncology services and reduce its debt burden. However, these measures may not be enough to save GenesisCare from bankruptcy, as the company still faces significant challenges in turning around its operations and restoring its profitability. The company also faces regulatory uncertainty, as its acquisition by China Resources Group is subject to approval by the Foreign Investment Review Board (FIRB), which may impose conditions or reject the deal due to national security or public interest concerns. In conclusion, GenesisCare's acquisition by China Resources Group and Macquarie Capital in 2016 was driven by an ambitious vision of expanding its operations in the US and Europe and entering the Chinese healthcare market. However, the expansion strategy proved to be costly and risky, as it saddled the company with a huge debt load and operational difficulties. The COVID-19 pandemic further exacerbated GenesisCare's woes, as it reduced its treatment volumes and earnings. Despite receiving additional capital injections from its shareholders and selling its cardiology business, GenesisCare may not be able to avoid bankruptcy unless it can improve its performance and resolve its regulatory issues. GenesisCare is a global provider of cancer care services, with operations in Australia, Europe, China, and the US. The company was founded in 2005 by Dan Collins, who recently stepped down as CEO. In 2016, GenesisCare was acquired by a consortium of investors led by KKR and China Resources. However, GenesisCare's expansion plans were hit hard by the COVID-19 pandemic, which reduced patient volumes and increased costs. The company faced a liquidity crisis as it struggled to service its $2 billion debt load. According to the Wall Street Journal, GenesisCare was preparing to file for bankruptcy within days and made the main reason for GenesisCare's financial difficulties was its U.S. division, which accounted for about half of its revenue but also had the highest operating costs and the lowest margins. The U.S. division was also exposed to regulatory changes and reimbursement cuts that affected its profitability. To avoid a default, GenesisCare tried to negotiate with its lenders and bondholders to restructure its debt and extend its maturities. However, the talks failed to reach an agreement, as some creditors demanded a higher recovery rate and more equity in the reorganized company. As a last resort, GenesisCare decided to separate its Australian arm from its U.S. division and use the U.S. bankruptcy laws to restructure its debt. The Australian arm, which was more profitable and stable, would continue to operate as usual and retain its ownership by KKR and China Resources. The U.S. division, on the other hand, would file for Chapter 11 protection and seek a new owner or partner. This move was seen as a desperate attempt by GenesisCare to salvage some value from its U.S. business, which had become a drag on its overall performance. However, it also raised questions about the future of GenesisCare's global strategy and its ability to compete in the highly competitive cancer care market. GenesisCare, a provider of cancer care services backed by KKR, is preparing to file for bankruptcy within days. The Australia-based company, which operates in 4 countries, has been struggling with a heavy debt load of more than $2 billion. The debt was mostly taken on to acquire 21st Century Oncology, a US-based cancer care provider. In late, however, the COVID-19 pandemic hit the company hard, especially in the US, where its earnings have been slow to recover. As a result, GenesisCare has been facing liquidity issues and default risks. Its debt has been trading at distressed levels, between 30C and 40C in the dollar. The company has been downgraded by credit rating agencies, such as S&P, which warned that it could undertake a distressed exchange or other form of debt restructuring that it would consider a default over the next 6 months. To avoid a potential default, GenesisCare has been exploring various funding options. It has been in talks with Oaktree Capital Management, a distressed debt specialist, about a possible rescue deal. However, no agreement has been reached so far. Meanwhile, some of its lenders have been selling their debt at steep discounts, putting new investors in the capital structure who are keen to get things moving. One of the options that GenesisCare is considering is to separate its Australian business from its US division and prepare for a bankruptcy filing under Chapter 11 protection. Chapter 11 is a form of bankruptcy in the US that allows a company to stay in business and restructure its obligations with the approval of a court and its creditors. By doing so, GenesisCare hopes to preserve its core operations in Australia, where it has a strong market position and stable cash flow. It also hopes to reduce its debt burden and improve its financial flexibility. However, this option is not without challenges. GenesisCare will need to obtain the consent of its shareholders and lenders to split its business. It will also need to negotiate with its creditors on the terms of the restructuring plan. Moreover, it will face legal and regulatory hurdles in both countries. For example, it will need to comply with the Foreign Investment Review Board (FIRB) rules in Australia and the Committee on Foreign Investment in the United States (CFIUS) rules in the US. GenesisCare's bankruptcy filing will be one of the largest and most complex cases in the healthcare sector. It will also have significant implications for its stakeholders, including its patients, employees, doctors, suppliers, and investors. The outcome of the process will determine the future of GenesisCare and its role in providing cancer care services around the world.